let's start. I guess, first of all, again, good morning. I hope everyone's doing well and that you are still hanging in there. We're rounding the corner here to the end of the semester. So, it's basically about 2 weeks left. Last day of class is June the 4th. And that's also the last day to withdraw from any classes if you are so moved. The first day to apply for that credit, no credit option that I've spoken about a few times is June the 6th. And the last day to apply is July the 16th. If you want to talk more to me about any of those things, we can talk offline. One thing that I just want to remind you about for next week before we actually dig into the material is that we don't meet on Monday because it's Memorial Day, but because the college is making up the Monday classes that are lost, we meet on Tuesday, the 26th, because it's a Monday schedule. All right. So I'm sure that some of you work or you have other things that go on, in real life on a Tuesday, but according to LaGuardia, hang on, can you still hear me? It's saying my internet connection is unstable. According to LaGuardia, Tuesday the 26th will be a Monday schedule. So I guess please just plan on that. I'm just trying to make sure that I'm on Ethernet. Yeah, sorry, just bear with me for a second. Okay. I think my internet should be a little bit better now. But yeah, how many times have I said this now? Tuesday next week is a Monday schedule. So we will meet as if it's Monday. All right. And make sure you arrange your life accordingly. I know it's inconvenient because, in your life, Tuesday may be the day that you take care of a family member or watch your child or go to work, whatever. If you cannot make the class, remember, it's not the end of the world. I take attendance in two ways. I take it in person here in the lecture. If you don't make the lecture, if you finish the work, then you would also be considered present. So please don't stress yourself out. And remember, the class is recorded, so you can always catch up. Next week, Tuesday, I would be going over the homework for chapter 17, which would have been due that Monday. And I guess anything that people still want to go over to do with the test, I can also deal with that. But remember the test, and I'll go onto the test prep sheet again. The test does open on Sunday. So, you have, I guess, some things to think about how you want to spend your time. So I'll just remind you that we've been through this before, but all the test and course information is on this tab over here. There's extra practice stuff. If you want to practice, it's all opening up on Sunday. Pardon me, but you have a whole week in which, time you can decide when you want to do it. The test is 20% again, was 2.5%. The timing is the same, the number of attempts is the same, and so on. And here you can see exactly which questions will be asked. So remember, Chapter 17 homework due by Monday, the 25th. I'll go over it on Tuesday. If you want to hold off on the test to ask any final questions and stuff on Tuesday, you're welcome to do that. And then the test will be due on the 31st. All right. Hopefully that's clear enough. If there are any questions, please ask me now or ask me during the break or at the end. Any questions about the material? Okay, doesn't seem like it then. I guess the last announcement that I'll make, and I'm sure those of you who this applies to have already received correspondence from the school, but on June the 16th, there will be a virtual ceremony for graduation, and there'll be some pre-recorded messages and keynote speakers and so on online. So again, if you want to, you're welcome to tune in to that as well. I mean, it's obviously a strange time, so it's unfortunately not the way we would have wanted to celebrate commencement, but but they're doing something at least to honor everyone who is graduating the semester. All right, so with that we move into chapter 18. This is the last chapter that we are meant to cover based on the syllabus, and this chapter basically brings a lot of what we've learned up to now to do with company financial statements. It actually kind of brings it together, and like the book says, you know, it's the big picture, because we're actually going to be using the financial statements that we've learned about, right? Income statement, balance sheet, statement of cash flows, and analyzing the financials in ways that would help us to get a better understanding of how the company is doing. So you might say, well, I can look at, you know, the financials and I would be able to see the numbers, and, you know, surely that tells me how the company is doing. Yes, it does, maybe for that year or that time period, but it doesn't tell you how the company is doing this year compared to last year, right? You may have to look at the previous year's financials. You may have to run some numbers. It also doesn't tell you how a company is doing in relation to its competitors. So if you were thinking about Target versus Walmart, you know, you can look at their financials, but the numbers are going to be very different to each other. So there's danger in saying, oh, this company has the most revenue or the most profit, so I'm just going to, you know, give them the loan or put my money into their stocks and so on, because it goes a little bit deeper than, you know, such a simplistic analysis. You also may want to know how the company is doing in relation to the industry that it's in, because if you're thinking about, again, let's say you're a bank, you're a lender, and you're trying to see whether you should loan them money, or if you want to buy stocks in the company, it's good to understand if the company is, you know, keeping up with everybody in the industry, or if, you know, it's trailing the industry. It helps you get a better picture of whether the company would make a good investment, whether for debt investment or equity investment. So at the start of the chapter, you see this gentleman's face. Many of you will already know that this is Warren Buffett. He is one of the most prolific investors of recent times. He follows an approach called value investing, which means that he uses his research predominantly around financial statements, so the same type of financial statement analysis that we'll just be doing. He tries to see whether companies are underpriced in the market. So this is not a finance class, don't panic, but I'm just trying to make the connection for you from what we're doing with our accounting numbers and how it gets applied. So basically he'll look at a set of financial statements, and I mean, many investors do this, and do the analysis, and then based on his analysis, even things like free cash flow, like what we did on Monday, based on the analysis, he will then determine, and I mean, he's been doing this for years, it's making it sound a little bit simpler than it is, determine whether this company's stock price is actually lower than what he thinks it should be based on the company's financial health, right? Based on how it's doing. And if you know anything about investing, I mean, even just logic would dictate that if you're going to invest in a company in their stock, you want to buy the stock when the price is low, and sell it when it's high, so that you can make some type of profit, right? So he's looking for undervalued stocks where he thinks the price of the stock is going to go up, so they can make some money. So he's been pretty, pretty successful, considering that his wealth is in the billions of dollars. And this book is, or this information is from long ago, 2012. So obviously he's even richer than this than this amount. And it's just saying, well, how do you translate what was at the time a wealth of 69 billion into something that we can actually understand? It said if you invest the money at just 4%, which is a low return, you could spend 7.6 million per day, every day, forever. All right, so I don't know about your shopping plans. Mine certainly don't go to the extreme of 7.6 million per day, but the point is not really that money, is everything, or we are only doing this to make money or something like that. I mean, there's nothing wrong with wanting to make money. What I'm just saying is the underlying thought around what they're trying to say is that he is using this type of financial statement analysis that we're about to learn. We're learning a somewhat, I don't want to say simpler form, but we're learning all the financial statement analysis, but we're not going to take it onto the finance side of things that you will do when you do a finance class. But the point is that what you're learning is very actively being used by people in the market, by people in business, and so on. And they go on to talk about Buffett and how he spends his money. He's very frugal. He's been living in the same house in Omaha for years, since 1958. He still drives his own car. Like, he's not living large, and he's committed to give all his money to charity when he's done. But again, those are decisions based on what you consider a life well lived is. The point is just that this value investing thing is largely driven by financial statement analysis. So why do we care? Right? If we're learning accounting, why are we talking so much about investing? Because the underlying financial statements that we've prepared and that we understand are drivers of this financial statement analysis that we will be learning about. And for those of you who maybe aspire to go into the world of finance, you will find that, and I can speak about this fairly at length, which I won't. I'll just studied accounting and finance, and also worked in various finance related fields. You have to understand financial statements. In fact, when Warren Buffett was, I don't know if I think it was, he came to LaGuardia before when he was here, or maybe it was on a video that I watched of him with the Finance Club. He stated categorically that in order to be successful in finance, you have to understand accounting. So accounting does really span the bulk of many business disciplines, and this analysis that we'll do, you'll see shortly, is very useful in understanding how companies are doing. So that's kind of the preamble as to what we're doing and why we're doing it. I just want to say that the chapter is divided up into 3 parts. The unusual items related to the quality of a company's earnings we'll deal with at the end. Horizontal analysis, I'll explain to you horizontal and vertical analysis, but those are less popular and less useful. The core of what we are going to be spending our time doing is this ratio analysis. And if you can already guess what a ratio is, right? You're talking about one number in relation to another. So what we'll be doing in this chapter is largely formula driven. And that's, I believe at some point I said to you guys that I guess I've said this many times, that in certain parts of certain chapters, when you're doing the test, or, when you're doing like the final exam or whatever, you need to have this information handy. So all these formulas that we'll go through, I do not expect you to memorize the formulas to kind of throw them back at me on a test, because even if we were working in person, I would provide you a formula sheet. The critical thing that needs to happen is for you to understand why this formula is important, how it's applied, right? How you plug the numbers into the formula, and then what it means, right? In fact, the last part, like what the conclusion is that can be drawn from the answers of that you get out of these formulas, is actually the analysis part. That's, where you can say, oh, based on this ratio, whatever, this company is doing well or not doing well, and so on. Anecdotally, I'll say that I I also sometimes teach in this program called 10,000 Small Businesses that's run out of LaGuardia by Goldman Sachs. And we deal with entrepreneurs who have obviously their own business, and I have to teach them financial statements in a very short period of time. But one of the things that we do deeply is ratio analysis for their financial statements. And often, again, it's the I'm not asking the people, what's the formula for X, Y, and Z? I'm asking them, or well, they're asking me most of the time, what does this mean, right? If I'm calculating these numbers, what does this actually mean? So as we go into running through all these different formulas, I want you to remember to ask that question at the end. If I'm calculating something, how does this affect the company, and what does it mean for the company? And the ratio analysis, you can see, right, that we will be doing is divided up into three parts. We look at liquidity, and we'll talk about this more, but liquidity basically means being able to pay your debts in the short term. Okay, if someone says, how liquid are you, they're almost in a way asking, how much money do you have in your wallet, right now? Can you pay off whatever debt, or pay this bill, or pay this account, or whatever? Solvency is talking about, can you settle your liabilities in general over the long term? So if you say that someone is insolvent, it means that their liabilities total, right, are greater than their assets. We've seen this type of insolvency many times in recent weeks. It's normally called bankruptcy. And you've probably seen Neiman Marcus filed for bankruptcy, J. Crew filed for bankruptcy, J.C. Penney was busy filing for bankruptcy as well. I think Fairway was on the food store was on the verge of filing for bankruptcy even before the whole COVID thing happened, and on and on. All right. So if you hear that someone or a company is, or even individuals can also file bankruptcy, is filing bankruptcy, what they're saying is that in the long term, my assets are smaller than my liabilities. I can't afford to pay. So I'm going to the court, right, to basically figure out who gets paid and who doesn't get paid. And then the last type of ratio is profitability. So this is basically saying, as the name implies, right, how much profit are we able to generate from our business? And of course, people care, right? People want to know that, it might be nice if you generate a lot of revenue, but if you aren't profitable, meaning that your net income is growing over time, then you're probably not the type of company that someone wants to invest in, because it's out of the profits, right? Net income goes to retained earnings. It's out of the profits that dividends will be paid. And investors are always concerned with getting a return on investment. Okay, so those are the three areas of the, I guess, ratios that we'll deal with. So now, hopefully, I know a few people joined late, and I'm not sure if you had a chance to go into Blackboard, but if not, go there now. Go to Zoom call materials, go to the Zoom call right for today, and there's the class notes for chapter 18. So I'm going to, like I said, I'm flipping it a little bit because I know sustainable income and quality of earnings is first in the textbook, but it's actually more helpful to first go through the ratios and then end with the earnings quality stuff, because otherwise it's a little bit disjointed from the previous chapters that we covered. So please go in and get the notes if you haven't done that. If you can't do that, you can also just follow along with me. All right. And as I said, I'll walk you through, the different type of analyses, but we will focus on ratio analysis. All right. So when we're analyzing financial statements again, we want to kind of be living in these kind of three major categories, right? The liquidity, how able is the company to pay its short-term debts, profitability, is it making money, and solvency, will it be able to pay the debt over a long time? So short-term for liquidity, long-term for solvency, and profitability. Can we make enough profit to survive and to pay people dividends if need be? So I mentioned this before, but I'll just go over it again. If I just calculate one ratio for a company and I say, oh, I'm done, that's nice, but it doesn't really help me to understand how the company is doing. So often, we try to compare the results of our calculations, either the company to itself, so that's called intra. Intra always means right inside. So the company to itself, where you look at, okay, how did the company do in 2020 versus 2019? You've possibly done this in your own life in various ways, right? Maybe you're saving, or maybe you're trying to pay down debt, or maybe you've got some goal. It could even be a goal that you have for exercise or weight loss or whatever. There's an internal comparison. You're saying, what was I doing last month versus this month? And so for companies, the same, right? So you might compare to previous years, you might compare one quarter to another, etc. So once you calculate some of these ratios, compare the company to itself or to the industry. So you look at other companies in the industry, or to another company that is basically you would consider a competitor. And that's what I was talking about when I said you would look at Target versus Walmart. Because, let's say I wanted to invest, right? And I look at Target stock price right now. Okay, so it's 120.47. And I look at Walmart stock price. And I say 125.55. So I'm like, oh, these prices are fairly close to each other. Which one do I like the most? Maybe that's where I'll put my money. That would be, frankly, a foolish way, of approaching an investment, because you don't know much more. So, I mean, this is also a warning to anybody. If someone just says to you, oh, yeah, Walmart is looking like a great investment right now, don't just run in and sign up for Robinhood or sign up for E-Trade or whatever and go and dump your money into something. You have to, and again, the stock prices are so close together that it might give the impression that the companies are kind of the same. That's not the case, all right? You have to actually look at way more things than just that. And so one of the biggest things is actually to start doing this. In finance, we call it fundamental analysis, which is basically you look at the fundamentals of the company, meaning the financial statements of the company. So it's financial statement analysis. All right. So when we want to look at competing companies, that's what we do. I think I might be too ambitious now to try and find this, but I believe that in this, it might even be in the homework, in this textbook, there's actually, it is, this problem. There's actually a problem that does some comparison between Target and Walmart. So you can, and I think it's assigned to you guys. So you can see then how all these different ratios are calculated, and how at the end the question actually says to you, please, draw conclusions about the liquidity, solvency, and profitability of these companies in relation to each other. Does anybody have questions so far? I feel like I'm talking forever, but it's always like this at the start of a chapter, so forgive me if you have nodded off to sleep by now. Any questions?
Nope, we're good, Professor, for now. Thank you.
You're okay for now? You're white knuckling through the explanations. Thank you. So tools of analysis. As I said, there's horizontal analysis, which I'll show you in a minute. So it's looking at the financial statement data over time, but this is mainly used when you're looking within the company. All right. Then there's vertical analysis, where you express each item in the financial statement as a percent of a base amount. This sounds very involved, like it doesn't make sense. So I'll just show you quickly what they mean. All right. So if we look at 18.2, this is an example. This is a very basic example of horizontal analysis, right? You're looking at 5 years from 2016 through 2020. How, excuse me, how has sales for this company, Chicago Cereal Company, in thousands, so it's millions. How has the sales changed, right, over time? And then of course you can maybe calculate a percentage or something like that. So horizontal is literally, as the word implies, you're looking across, right, to see how things have changed, hopefully improved, obviously, and doing some calculations. And there they have the percentages. So if you treat 2016 as the base year, this is the change, the increase in sales, right, over time. Again, we're not spending tons of time on this, because this is, I mean, it's useful, but it's less useful than the ratio. So don't panic. There's no homework and so on questions on this. I'm just letting you know how this works. All right, and it's fairly easily done. And then let me see if they have that's still the horizontal analysis. Okay, so then we come to vertical analysis, sometimes also called a common size balance sheet or common size income statement. And the reason they call it common size is, if you look at this balance sheet, they treat total assets as 100%, and every other number under assets is being expressed as a percentage of total assets. So you can see, and again, it's most useful if you're looking at least at 2 periods. You can see how things shift, year over year. There's not much change here, but by expressing all these numbers as a percentage of a base number, you can get an idea of how the numbers have changed. And over here, liabilities and stockholders' equity are also being expressed as a percentage of the total. So you might say, well, who cares? Why would I do this? And for the income statement, net sales is 100%, and everything else is a percentage of net sales. What this does is, sometimes if you can pull these charts out of QuickBooks, or you can do it in Excel. It at least gives you an idea. For instance, you have a notion of how cost of goods sold has changed as a percentage of sales over time. I did this to some extent with some of the business owners, because this would help you maybe to keep track of costs that are growing, quite a bit. Frankly, in this company, there's not that much going on. Also, it sometimes automatically calculates certain ratios anyway, and you can pull them off the sheet. So this is vertical analysis, and then horizontal analysis. Again, not something that we're focusing on very much. I'm just showing you how it looks. And where we will focus is the ratio analysis, which is not driven by just having numbers lined up on a sheet and doing some type of percentage calculation, but more driven by formulas. All right. And again, I know a few people joined late. Just to set your mind at ease, you don't have to memorize the formulas, but you do know how to apply them. You do need to know how to apply them, and you need to know how to interpret the result. So ratio analysis expresses the relationship among selected items of financial statement data, and that's where our focus lies. A ratio could be a mathematical relationship. Well, it is a mathematical relationship between one quantity and another, and it could be expressed in all different ways. So that's another thing sometimes where students struggle with ratio analysis is it a percentage? Is it a rate, like so many times over? Is it a proportion, like 2.5 to 1? As we calculate the different ratios, I will say how to express it, right? So you will have to, that's part of knowing, right, how to calculate the ratio and how to apply it. And we've already discussed the three different areas that we will look at. So to start with liquidity ratios, what's nice, and let me see here where the book does this as well. You can organize these ratios right by type. So yeah, you in your book you can see there's a little uh, illustration that shows you all the liquidity ratios along with the formula, and as you go through you see profitability and solvency ratios. So and obviously step by step showing you how to apply the formulas as well, but we will do that together anyway. I'm trying to see. Yeah, it doesn't look like it. They used to have a nice sheet where everything was condensed into one, but I guess they've moved on from that. So purpose of the liquidity ratio is to measure the short-term ability of the company to pay its maturing obligations and to meet unexpected needs for cash. So short-term, right, ability to pay your debts. That's what I was saying earlier, and that's what it is. If you understand overall what these ratios are about, then it also helps you to understand the individual ones. So we start with something called the current ratio, which you may, I don't know, it depends on how your accounting one class went, but you may have had some exposure to it in accounting one. Basically, just in short, and then I'll go into the writing, what the current ratio is measuring is how many or how much of current assets does the company have for every dollar of current liabilities? Because what we're trying to see is if the current liabilities are what's coming due in the short term, will the company have enough money and enough current assets to actually pay that debt? So it's the short-term debt paying ability of the company, how much of current assets for every dollar of current liabilities. And be care, because if you look at a company's balance sheet and you look at all the current assets and they're less than the current liabilities, what it implies is that the company is not going to be able to meet its obligations. And so it's like you saying my rent is coming due, on the 1st, and my rent is, $1,000, and at the moment it's the 31st, and I only have $900, right? You only have 90% of the amount of money that you need. So for every dollar of a liability, you only have 90 cents of assets. So for someone looking to lend money to a company or to invest in the company, you would be concerned that they may have a cash crunch, right? And that they would have to go and try to borrow from somewhere to meet their obligations. And then within the current ratio, there's also another, this isn't so much a ratio, it's just a calculation. That's called working capital, where we're just saying, if we subtract all the current liabilities from the current assets, how much of assets do we have left over to actually still work for us in the company? So it's just measuring in a different way whether our current assets are in fact larger than our current liabilities. All right, so that's the current ratio. And I think in order to break up the monotony a little bit, what might be helpful is if we actually just go to an example. And the formatting here is a little bit sketchy, so forgive me, but I'm looking at example 2 on page 5. You should have page numbers. If not, it's Wimmer's Corporation. All right, so hopefully people are have already downloaded the stuff and they're there. So this is normally, let me move this thing up. This is normally how the information is provided, some type of financial statements or some type of condensed financial information, and then you are given instructions on what you should be calculating. And they're asking you to calculate the ratios for 2017. So that helps to make sure that you don't get confused. So we want the ratios for this year, but we also have 2016 because we'll see in a moment that the some of the formulas for some of these ratios require us to have a beginning and ending balance, all right? So looking at the balance sheet for Wimmers, we've got our classic cash, accounts receivable, whatever, inventory, etc. And then you've also got, your liability and your stockholders' equity. They also tell you that Wimmers 2017 income statement included net sales of 100,000, cost of goods sold of 600,000, and net income of 15,000. So they're giving you that information because they did not provide an entire income statement, but when we do some of these other ratios, we will need information that comes from the income statement. So the first ratio that they ask us to calculate is, coincidentally, not, but coincidentally, the current ratio. So if we go back up, right, to hopefully you don't need too much refreshing, but to refresh our memories, we know that the formula for current ratio is current assets divided by current liabilities. So here comes the struggle now, because you have to know what qualifies as a current asset. Hopefully from our time spent working on the cash flow, you have some, better understanding of that. So I'm gonna, especially for this whole first example, I'm gonna work the problem through with you guys so that you can see how we approach it, and then after that we'll see about maybe having you guys work through something on your own. So I'm just gonna try and get a new spreadsheet here, and you do the same, get a new piece of paper or whatever, and get ready to do some calculations.
Professor, which number is this?
This is number 2 on example 2 on chapter 18. I have page 5. I don't know if when you pull this down, if you're getting a page number or not.
Got it, thank you.
So we're looking for the current ratio. So yeah, if you were doing this on your own, you would be looking at the formula sheet and saying, okay, so it's current assets divided by current liabilities. So then the question becomes, what all goes into current assets? Do people want to call out stuff that they think should be included? What should be included in current assets?
Cash, equipment, inventory, land,
Not
building,
land, but cash, yes. Accounts receivable.
account receivable, yep.
Yes, inventory, yes, that's it, okay. Land, buildings, those are property, plant, and equipment, so they won't be current, they could be used for something else. So we're adding, and you guys should have the example in front of you, so I'm taking, this is the 2017 dollar amount for cash, okay, that I'm adding. And remember they asked us for the ratios for 2017. I'm also adding accounts receivable. Net means that the allowance for doubtful accounts was already subtracted, and then I'm also sorry, that's too much. Excuse me. Then I'm also adding inventory. So together my current assets are 35,500. All right. Questions there? Are we solid? Very good. And now we have to go back and look for current liabilities. Well, this situation is a little bit easier. Obviously, retained earnings, not current liability, nor is common stock, so it's only this number for accounts payable, 12,370 that we need to. Oops. And it's not the case that normally there's only one current liability. Often there's more than one. Sometimes the financial statements actually present the numbers in such a way that you already see the total for current assets and current liabilities. So you need to be prepared for the numbers to be presented in all different ways. The important thing is that you should know which accounts are current assets and current liabilities. I think that's the bigger issue. Sorry, so what we do now is we divide the 35,500 by 12,370. Sorry, my throat is really dry there. And you should come out to this 2.86 and a whole lot of other numbers. I generally round to 2 decimals. If you're working in Wiley, round to whatever they tell you to round, because they have their own preferences. And the way you write this is 2.87 to 1. You see the colon, dot, 1. So that's how the answer is presented. Remember when we were reading right at the beginning of the chapter, we were saying that sometimes the ratios are presented as a proportion, and this is one of those, 2.87 to 1. Any questions on the calculation before I discuss the meaning of it? Okay. So now, remember I told you that you have the formulas at your disposal. The bigger issue is, what does this mean, right? So if we have current assets at the top and current liabilities at the bottom, the 1 is representing the current liabilities and the 2.87 is representing the assets. So if you looked at this and you just looked at how the formula was structured, you could probably already guess that for every dollar of current liabilities, I have $2.87 of current assets. So I will type that in here. For every dollar of current liabilities, the company has $2.87 of current assets. Does that sound decent? What do you guys think?
There's a profit.
Yeah, I mean, you can just say that you can pay your current liabilities 2.87 times over, right? So that's not bad. So it's like saying, remember when I was talking about the rent example? If your rent is $1,000, this is like saying you have $2,870 in your account, so you will be able to easily pay your rent and have some money left over. So someone looking at your financials would be like, okay, you're in decent shape, right? And the general rule in business, don't ask me where this rule comes from, but the general rule is that we consider 2 to 1 to be a good ratio. So generally in business, people want to see that a company is able to cover the current liabilities 2 times over with the current assets. That's considered, I guess, if you want to call it safe, right? So if we're 2.87 to 1, then we're in even better shape. Questions there? All right. So that's current ratio. I guess to just round it out, I'll say that it's the same formula every time. If you're asked in a question to calculate current ratio, the formula is going to be the same. The meaning is the same. So, this chapter, it would become very, what we would call rote. Like you can just learn how to do the thing a few times, and then after that, it's going to generally be the same approach. Okay, so it's some of the easier work that we've done together. All right. So current ratio is done. We weren't asked to do working capital, but if we had done it, let me just show you. Um, yeah, I'll do it over here. So working capital was current assets minus current liabilities. All right, so we're going to say 35,500 minus 12,370. That's how the formula runs, and so it's 35,500 minus 12,370. So you have 23,130. So after you paid off your liabilities, you still have $23,130 of current assets to work for you in the business. All right. So that's all that working capital means. And it might seem a little bit random, but like I said, a lot of these formulas and things drive decisions around finance and investing. And I can't tell you how many times when I've looked at, in my past life at Deloitte or whatever, when I've looked at people valuing companies, working capital comes up big time because they want to know if I buy this company today and I have to settle all these debts, how much loose liquid, assets will I actually have left over to work for me in the company. So that's working capital. So the next formula under the liquidity umbrella is what we call the quick ratio or the asset test ratio. And you'll see in a minute here why this even comes up. So it's a measure of a company's immediate short-term liquidity and important complement to the current ratio. So it only includes highly liquid current assets. All right. So what does this mean? Well, when we do the current ratio, we include all current assets. And the reality is that some current assets are closer to cash than others. Like cash is cash. So obviously you can use that money to pay off debts immediately. Accounts receivable is fairly close to cash because you'll be collecting from your customers to get your money. But inventory, although it's a current asset, so implying that it could be converted to cash, it's going to take a little bit longer to actually get the cash out of it because you have to sell your inventory before you can actually get the cash. So sometimes companies have balance sheets that have a big current asset amount, but when you start digging, you realize that a lot of it is to do with inventory, and you may not, or the company may not be able to sell the inventory quickly enough to be able to pay off its current liabilities. And similarly, there's another type of current asset that is also very difficult to convert to cash, which is prepaid expenses, right? If I pay my insurance for my company today and I pay it for the next year, I can't really go back to the insurance company and say, oh, give me my cash back because I need to pay off my accounts payable. So even though it's a current asset, prepaid insurance or prepaid expenses, it's not that close to cash. So the quick ratio goes a step further than the current ratio and says, instead of just saying current assets total, we're only going to include cash. Any short-term investments, like here you might think of a certificate of deposit or some type of, fixed deposit that you can easily liquidate. And the receivables, that's it. We're going to ignore inventory, prepaid expenses, and so on. And then we're going to compare that to current liabilities to see if we truly are able to pay our liabilities with things that are super close to cash. So if we go back to this example number 2, what we will just do now is we'll take cash and we'll take accounts receivable, but we will ignore inventory, right? And you can see that inventory is $10,000, so it's going to be a pretty big drop in our current assets. So this is going to be the asset test, why do they call it asset test or quick ratio? Probably sounded like a good name at the time, but it's somewhat mysterious. Um, so what all goes into it? You normally would add cash. You would add, like I said, any short-term investment, and that would be marked as such on the financials. And you would also, sorry, you would also add any receivables. And the net again just means that the allowance for doubtful accounts was already removed. So all of those together divided by current liabilities. And so for our purposes, as I've said, we actually only have cash and accounts receivable, right? So we're going to ignore inventory, and we don't have any short-term investments. So this comes out to 25,500. The liability stays the same. It's just the accounts payable. There's nothing else to do. You don't have to adjust liabilities in any way for the quick ratio. And so, sorry, we divide the 25,500 by the 12,370, and this is what we get, 2.06 to 1. So that's not too bad, right? Because the company still has $2.06 of current assets for every dollar of current liabilities. If the inventory number had been much larger, it would have affected, the asset test ratio more detrimentally. But for now, we're in good shape. So for every dollar of current liabilities, the company has $2.06 of current assets. So we're still good. Questions there? Okay.
So we just have to remember the formulas in order to make sure we get the right.
Yeah, I mean, you don't have to. Remember I'm saying you have to be able to apply the formula. You can print out the formula sheets and have them next to you. You need to know how to use the formula, right? More so than remember. Maybe we're saying the same thing differently, but my concern is you don't have to memorize how to do this because you can see it in the textbook, but you need to know how to do this part, right? And then you need to know how to explain it. Make sense?
Yes, thank you for
Okay.
that.
Yeah. So it's not super hard, but it's more often than not, it's this piece where people struggle in explaining what it means.
I have a question.
Yeah, go ahead.
So in the test, it's gonna be the same, like writing down for the answer, like it has to be like the same, or how is it gonna be in the test?
I don't know what you mean by the same. The same,
Like,
like the calculations will be the same.
yeah, like let's say for the answer for the asset test ratio, it says for every $1 of current liability, we have to write all of that on.
Well, I mean, if something asks you what does this mean, absolutely, you have to understand what it means. Is that what you're asking me? Like, do you have to use every single word the same like I do? No, but you still have to convey the same meaning. So you can't just say the company. I mean, I'm not saying that you're going to say this, but if you just wrote the company has $2.06 of current assets without saying anything else, that's only half the answer. So for the most part, this is probably the shortest way to say the same thing. Or you can say for every dollar of liabilities, the company has 206 of assets, but you're still basically saying the same thing, right?
Okay. All right.
So sometimes this is, and I'm glad you're asking this because often it's this piece where people sometimes are struggling to know what to do. If you remember it like this, you'd be fine. But I guess I don't want people to be concerned that they have to write it, word by word, bullet by bullet, but you should at least have a similar meaning.
Okay.
All right. So
Yeah,
this,
'cause I believe that's the like the answer is like the minimum for the every exercise, right?
do you have to give the explanation for every exercise? Is that what you're asking me?
Yeah, yeah.
No, not necessarily. Like some of the exercises, you just do the calculation and they don't even ask you. Like even
Oh,
this
okay.
exercise, you can see. Um, I'm just explaining to you guys what the stuff means because at some point you are asked to discuss. But in this question, and I took it from the textbook, they only ask you to calculate the ratios. They don't even ask you to explain them. So sometimes
Okay.
you will just have to calculate the ratios, and that will be the end of it. But there are times then you have to explain them. And so, I mean, I'm responsible to make sure that you know how to do that. And of course, as you move on in life, you have your own business or you carry on your studies or whatever, it's going to be important for you to understand what they mean. Because, for instance, you could end up going to a bank to ask for a loan, and the bank is going to run some of these calculations, and you could basically run them yourself sometimes before the time so that when they ask you about it, you would have good explanations for them.
Okay. Thank you.
Mm-hmm. Okay, okay. Anything else, guys? All right. So, moving along swiftly. The next part of so we kind of did the current ratio asset test. The next piece and the one that follows has to do with accounts receivable and inventory. You may again have seen this stuff. I don't make many assumptions that people have seen the things before, but it might help to jog your memory that you may have seen this in accounting one when you were dealing with inventory in chapter 6 and when you were dealing with accounts receivable stuff in various places, including I think chapter 9 or something, when you deal with all the allowance for doubtful accounts. Nevertheless, if you don't remember anything, that's fine because we'll go over it from scratch. But I just feel like maybe it sounds familiar to you, and that's why it is familiar. So we start with receivables turnover, and then there's also a second one called the collection period. The receivables turnover measures how quickly a company can convert receivables to cash. So, accounts receivable is obviously the balance that is still owed by uh, our customers because they haven't yet paid us in cash, and so it represents, something that needs to be converted to cash. The faster we can make that conversion, the better, because we obviously want to have the cash in hand. So the number of times on average that the company collects receivables during the year. So when we say turnover, it's almost like a wheel that's turning. You're saying how many times does this wheel turn over? And in this case, you're saying how many times are we collecting the receivables? It doesn't mean you're going to the same person to collect the same amount twice. It's just saying on average, how many times do we collect? So receivables turnovers, here's the formula. Net credit sales, so it's got to do with sales and sales on account, obviously only, because any cash sales you would have received the cash already. And net is just talking about sales minus any sales discounts and minus any sales returns and allowances. And you take that net sales number and you divide it by the average net receivables. Average, for the purposes of this chapter, is going to be the beginning number for anything, so the beginning receivables number, plus the ending, so the beginning balance plus the ending balance divided by 2. That's across the board, okay? If you see a formula that has average, somewhere in the formula average of some number, you have to take the beginning balance, take the ending balance, add them together and divide that by 2. And net, again, I've said this several times, means receivables minus any allowance for doubtful accounts. And here's the definition of net sales: sales minus sales returns and allowances and minus any sales discounts. Okay, so that's the formula for receivables turnover, and I will walk you through how to do this now with our example. All right. So here we see the accounts receivable numbers for 2016 and 2017. Since we're being asked to calculate the ratios for 2017, the ending balance in 2016 would be the beginning balance in 2017. So for the average net receivables, we would add these two numbers together and divide by 2. We're still looking for a sales number. So net sales of 100,000. It doesn't say net credit sales, but we'll have to assume that all sales were on account because the question isn't telling us anything differently. So we've been able to locate the pieces of information that we need to calculate this ratio. So accounts receivable or receivables, receivables turnover are both acceptable names for this formula. And we're going to use net credit sales. Again, we don't, yeah, we just have a sales number, but it's fine. Divided by the average net receivables. What's going on with my spelling today? Okay. And so the net credit sales number, easy because we get it off the information that's given to us in the question, but the average net receivables we will have to calculate. So remember, you're taking, I'll just write it here, you're taking the beginning balance plus the ending balance, and you're dividing that by 2. So I'm just going back to the question. So for receivables, the beginning balance was 23,400 and the ending balance was 21,200. So together that comes to 44,600. We have to divide that number by 2. So the average net receivables is 22,300. Questions on that calculation? Hang on, let me move this one. We're okay. So this number we have to plug in at the top over here. Okay, so divide by 22,300. So 100,000 divided by 22,300. So we get this bunch of numbers. So it's going to be 4.48. And how do we express that? Remember, I told you I'll let you know for each one. This you say times, 4.48 times. Now it's back to what does this mean, right? So the way we explain it is the company collects its receivables balance on average 4.48 times per year. So a bit, maybe this is a little bit tricky to understand sometimes. So maybe one way of thinking about it is if the company sold $100,000 worth of items, whatever it may be. If they collected the receivables 0 times, then the receivables, or not 0 times, one time, then the receivables balance would also be 100,000, and we basically wouldn't have collected anything, but it would be like one time because you kind of have one shot at collecting it. So what I mean is this, because I feel like I'm being confusing. So let me say it this way. If we only collected it one time, then it would look like that, and obviously the answer would be 1. Right, one time over. But because we don't have so much of receivables left over at the end of the year, it must mean that we collected what was owing during the year. And in order to come out to a receivables balance of only 22,300 at the end of the year, we must have gone through and collected our receivables about 4.5 times over during the year. Remember, the entire 100,000 of sales wasn't made at one time. It would have been made at various times during the year. So what do you need to remember? Obviously, you need to know which numbers to punch into the formula. And then just that what this means is that the company is collecting receivables on average 4.48 times per year. Question on that one, because turnover can sometimes be a little bit of a tricky concept to follow.
So the beginning balance and the ending balance, which stores did you
Where did it come
buy?
from? Are you
Yeah.
asking me? Yeah, sure. So if you look at the question, right, the receivables at the end of 2016, I took the 23,400. Do you see that?
Okay.
And then I took the 2017, the 21,200. That's the beginning plus the ending balance. And then I divided that by 2.
Oh, okay. All right.
Got it? All
Yes.
right.
Thank you.
What else? Anything else?
So if there was 3, so you just add the third one and divide it by
No,
3.
you won't. No, you won't. You got to know which. It's good you asked us. So let's say there was another column that said 2015, right? If you are calculating for 2017, you only take 16 and 17 because it's just beginning plus ending.
Got it.
Yeah, if you were calculating for, but this is, again, these are good questions, because if you, let's say in one question, you were asked to do the calculations for 2 different years. So you might have another column for 2015, and the question is saying not only to calculate for 2017, but also for 2016, right? So if you were doing a calculation for 2016, then you would have to have 2016's receivables and also 2015. Because then you would average those 2 together. Make sense?
Yes.
So, it's good to ask this because there are, from time to time, there are questions that actually ask you to do 2 years. So when you're averaging stuff, you have to be careful to make sure that you're averaging the correct thing. So thanks for asking that. And thanks also for asking about which numbers I use, because I realized I didn't put them in the parentheses. All right. So that's accounts receivable turnover. Let's do inventory turnover before we take a break here, because then, oh, sorry, I still have to, sorry, I'm getting ahead of myself. We still have to do the average collection period. Apologies. So within accounts receivable, we have average collection period, which in my opinion is a little bit of an easier way to understand how well we're managing receivables. Basically, the collection period is just asking how long in days, right, does it take for the company to collect its receivables. So here's the formula, right? It takes 365, which is obviously because of the number of days in a year, and you divide it by the receivables turnover, which you just calculated on top. All right, so let's do that. Let's see, they call it average, so I'll just call it average as well. So the average collection period, right, so it's going to tell us in days, right, how long it's taking for us to collect receivables. So 365 divided by, and we call this accounts receivable turnover, so I'll call it the same, accounts receivable turnover. That's the formula. So you'll take your $365 and divide it by the same 4.48 that we just calculated up top. So if you were doing these 2 formulas, obviously you would have to do the turnover number before you can do collection period. So 365 divided by 4.48. So you've got 81 0.395. So we normally, because we kind of say, well, if it's going to be part of a day, it's really taking us 82 days, right? You can round to the next whole day. So it takes about 82 days to collect the receivables. So yeah, your explanation is that it takes the company approximately 82 days to collect receivables. What do you guys think? Is that a good amount? Is that a good collection period or no?
It's less than a year.
Yeah, but I mean, if you were running a business, would you be happy that it takes you 80 days to collect
No.
money from your customers? Long, right? Because
Yeah.
probably your accounts payable is going to be paid, is going to require to be paid within 30 to 45 days. So if you are only getting money from your customers after 82 days, you're going to have a problem with being able to pay your bills, right? So it's like, I mean, if we think of it practically in our own lives, if you worked for a company and they only paid you after 82 days, I mean, you're talking about like 2.5 months. How are you going to pay your rent? You know? So I'm just going to put my opinion. This is a fairly long time to wait because generally bills are due from creditors, right? Within 30 to 45 days. So the confusion then becomes, how on earth do we pay for our bills if we're not collecting from our customers? And if you're thinking about going into business and stuff, these are the types of things that you have to be aware of if you're going to give people credit. You almost have to have a separate person that isn't as busy as you are, kind of just calling people up to make sure that they pay the amounts that they're owing, so you don't end up working so hard in the end have no cash to show for it. Any more questions about accounts receivable stuff?
No, Professor. Thank you.
Okay, so inventory, I'll go for 3 more minutes, then we can take a break. Inventory turnover, it's kind of the same idea. I mean, I know accounts receivable is to do with collecting money, but with inventory, it's just got to do with how long does it take us to sell our inventory, right? Because again, all these things come back to cash, like how quickly can this stuff be converted into cash so that we would be able to pay any liabilities that come due. So inventory turnover also talks about the number of times on average the inventory is sold during the period, during the year, right? How liquid is the inventory? Accounts receivable turnover, remember, is how often do we collect our receivables? It's all got to do with how quickly can we get to cash, right? And so the formula for inventory turnover is cost of goods sold, which would be given in the question, or maybe you have to calculate it. And there's a way to calculate it, and I'll discuss that, divided by average inventory. And once again, we have this average, so already you know, right, formulaically, that average just means the beginning balance of this thing plus the ending balance of the thing divided by 2. So that's how we apply the formula. And then we have a similar formula like the collection period that we had. The days in inventory is also asking how long, on average, does the inventory sit on the shelf, basically, before it gets sold? Because that's another question around how quickly is it converted into cash. You can imagine that if you were the warehouse manager, or you were some type of purchasing agent for a company, that these are the types of things you want to know, because you don't want to buy inventory that the customers are not interested in purchasing, because then you end up with your shelves full of things that are not being sold. And I mean, it's obvious that in retail, shelf space, especially now with so much push to online shopping, that shelf space is like gold. If someone's actually going to bother to go into a store, you want the things that are in the store to be things that people actually want to buy. Otherwise, you're paying massive amounts of rent to store things that no one is buying. You're not converting it to cash. So for this company, let's just do the inventory turnover, then we can take a break. So here's the two inventories, right? There's an inventory for 2016 ending balance of 7,000 and for 2017 ending balance of 10,000. We're doing the calculations for 2017. So the 16 ending balance of 7,000 would become the beginning balance, right, in 2017. So inventory turnover, cost of goods sold divided by the average inventory. So now the question is, do we have a cost of goods sold number? If we go back, we can see that they did in fact give us something over here. This is why it's crucial to read the whole question, right? Otherwise you might think you don't have it. So cost of goods sold was 60,000. Sorry, I know I'm having so many problems organizing this thing today. So 60,000 is my cost of goods sold. And then the average inventory, I'm going to have to calculate, right? So again, it's beginning inventory plus ending inventory over 2. So beginning and ending, 7,000 plus 10,000, right? So here's the numbers for 2016 and 2017, and you're just dividing by 2. I mean, this answer is obvious, but I'll just do it, the formula. Okay, so 8,500. So then you bring that number up here to be used in this formula. Should have given myself a little bit more space. So the 60,000 of cost of goods sold divided by the 8,500 of average inventory. So you come to the 705, and then we round to 2 decimals, the 706, and you also say times, right? 7.06 times. And how is that explained? The same as what we said with accounts receivable, except now we're dealing with inventory. So the company sells its inventory on average 7.06 times during the year. If they sold it one time, then inventory would be 60,000, right? So because inventory is only 8,500, but you've got all this cost of goods sold of 60,000, it must mean that the warehouse is almost depleted because they've sold the inventory so many times. All right, when we come back from a break, I'll do days in inventory, and I'll also just show you the formula for how to calculate cost of goods sold if the number isn't given to you. Okay, so we'll be on break until 12:03. I'll step away from the computer maybe for about 2-3 minutes, and then I'll be back if anybody has questions. I'm back if anybody has questions for me. All right, so we're back from break, and we just finished the inventory turnover calculation. As we said, at 7.06 times. So that means that the company sells its inventory on average 7 times during the year. Um, Two things that I wanted to still do is to show you how to calculate cost of goods sold if for some reason that number is not provided. And then secondly, obviously, we have to do the days in inventory. So if cost of goods sold is not provided, but other numbers are, again, This is something that would have come up in accounting one that you may or may not recall, but there's actually a formula to calculate cost of goods sold. And the way it goes, is you say the beginning inventory that the company had on hand, right? You add any purchases to that, and the question would have to give you the purchases number, and then you subtract the ending inventory from these numbers, and that equals your cost of goods sold. So if you run into a question where you need cost of goods sold to calculate something and you're not given the cost of goods sold number outright, but you are given beginning and ending inventory and purchases, the question is expecting you to know that this is how you calculate cost of goods sold. So please remember that, just in case you have to apply those principles. All right. Um, so we're done with inventory turnover. And this question doesn't ask for days in inventory, but I'm going to do it anyway, just to close the loop. So days in inventory, how many days is the inventory on the shelf, right, before it gets sold? Same idea as average collection period is 365 for the number of days in a year divided by the inventory turnover. So 365, and you divide that by the 7.06. So this is 51.7 days. So we round to the next whole day. And the reason I'm doing that is because you can't really say that it only takes 51 days. It takes more than that. So we just say it's 52 days. So what does this mean? Inventory is on the shelf for approximately 52 days before it is sold. Now, good, bad, ugly, it depends, right? Unlike with accounts receivable, where we're just like, well, we can't wait 80 something days to get our money. If this was a luxury car dealership, and every car you sell is like $500,000, it's probably okay, right? If it was a luxury car dealership. But if this was a restaurant, right, that has perishable foods and stuff, it's probably not okay unless it's canned goods or something. Sorry, canned goods or something like that. But if it's just fresh produce and fresh stuff that they're supposed to be using, 52 days is too long. So what often happens with companies is they may do this overall calculation, but then they may find that they have to dig into this number a little bit more and actually start splitting the inventory up into different inventory types, and for each type of inventory calculate the days in inventory to see how the number shakes out. Like, think about it, if you are Macy's or Walmart, or maybe Macy's is not the best example, but a Target or Walmart, where they sell durable goods and they sell perishables and so on. Just having one number for days in inventory isn't as useful, because that's just the average for how long everything has been on the shelf. Whereas if you had to split the calculation further between perishable goods, durable goods, whatever else, home goods, etc., then it really helps to get a better picture of your inventory management. Any questions? Yeah. All right. So just to think back to what we were saying at the start, of the class, remember, all these things are often used by analysts to see how companies are doing. And normally you would, compare this number to how the company was doing the previous year. You could compare it to how the industry is doing and so on. So it's good to know what it means, but also probably the next step is to compare the company at least to itself to see if there's been an improvement or not. So we're done with all the liquidity ratios. So this brings us to profitability ratios. And here we have, quite a few ratios to cover. And so I'll go through all of them with you. And where we can, we'll calculate them in this example, but I think there are a few of these profitability ratios that don't appear in example 2, but they do in fact appear in example 1. So I'll finish up example 2 with you, and then for the stuff that where we need to close the loop, we'll go on to example 1, all right, depending on time and so on. So profitability ratios measure the income or operating success of a company for a given period of time. Obviously, a lack of income will affect the company's ability to obtain debt and equity financing, to pay its debts. And so the company is not going to grow if the profits aren't growing, right? That's well, or if the profits aren't growing, let's put it the other way around. If the profits aren't growing, it's an indication that the company's not growing. And frankly, nobody wants to invest in a company that is either, just maintaining, like just running in place, or is in fact declining. That would be even worse, right? So we use these ratios to try and see the company's ability to generate profits and also to grow those profits. So the first one is the profit margin, right? So the percentage, it's measuring the percentage of each dollar of sales that results in net income. So it's saying, well, you have all these sales right at the top of the income statement, but how much net income do you actually end up with, right? So another way of thinking about it is how well are you controlling your expenses, so that you can actually convert as much of those sales into net income. If you decide maybe that you want to start a tiny, small business for yourself, just starting up, you may want to project how much you think you can do in sales, how much money you'll be able to make in sales, but then you also absolutely have to try to predict how much it's going to cost you to make those sales, because eventually you'll be able to see whether there's even a profit to be had or not. So like a simple business, I remember I had a friend some time back. She's a very good baker and chef, and she decided that she was going to do to bake cakes because people wanted her to bake, but not just standard cakes, like really really decorated and intense cakes for people's various celebrations. And she was just saying, well, the price of X dollars, is what I'm going to charge for the cake. And then I asked her, well, but how much does it cost you to make the cake? And she was like, well, the flour and the butter and whatever. And I'm like, yeah, those are the ingredients. But what about your time? What about the electricity that you use to have the oven going? What about the gas that you are driving out to go and buy the ingredients, etc.? So in the end, we saw that the price that she was going to charge was barely covering her expenses. So if she had done a profit margin calculation at the time based on her projections, we would have realized that for every dollar that she was getting in sales on the cake, because her costs weren't completely calculated well or controlled, she wasn't ending up with much net income. So we want this percentage to be as high as possible. We want as much net income to be generated from our sales as possible. And you can easily calculate these numbers, for companies that you're thinking about investing in, or calculate it for yourself if you're planning to create your own company, even based on projections. So net income is given to us here as 15,000, and we also are given the sales number, right? at 100,000. So, I mean, it's kind of already very easy to see what the answer is going to be, but we'll calculate it formally anyway, right? So profit margin. So we're in the profitability, ratios. So profit margin, it's got to do with net income divided by the net sales. And I hope that by now you're seeing that this work is not that hard. It's just often with the explanations that people get stuck. So you're going to take the 15,000 given in the question for net income. You're going to divide it by the 100,000 that's already provided as the net sales number. So you get this 0.15, right? So this number is expressed as a percentage. So the 0.15 will convert to a percentage. It's 15%. Remember, we said that there's a way to express all of these ratios. Some are days, some are times, some are proportion, some are percentages. You have to remember what's what, okay? And now the question is, what does this really mean? Okay, so I had 100,000 in sales and I ended up with 15,000 in net income. So it must then mean that for every dollar of net sales that the company generates, it has only 15 cents of net income. Now we say, well, is that good or bad? It depends, because it depends on what this number was for the company in the previous year. It depends on what the number is for the industry. It depends on what the number is for a competitor. But now we know how to calculate it. So if we could go and request or go and find through our research the same information for 2016, and we would be able to calculate, right, the percentage and see if it has gone higher. Remember, we want this percentage. Let me just write it in here again. We want this percentage to be as high as possible. So that's profit margin. Fairly simple to follow and hopefully easy to see that you would want this to be as high as possible. If you had no expenses, right, then this percentage would obviously be 100%. But obviously you have expenses, so the more expenses you have, the lower this percentage gets. But we want the percentage to be as high as possible, so we need to try to reduce our expenses as much as possible or increase our sales as much as possible. So that was profit margin. Now we come to asset turnover. Asset turnover, again, this notion of turnover, how many times is something happening? So it measures how efficiently, and efficiently, another way of saying that is how well does a company use its assets to generate sales, right? So obviously, if you have a business, there's going to be some type of investment in assets. We go back to this baking business that I was dealing with my friend. She had actually invested in industrial style oven, a stove and oven, and all kinds of baking equipment and so on. So those were the assets that she used. And so if we were looking at a business, we could look at asset turnover by saying, okay, so you spent, let's say $300 on all of the stuff. I think it's too low, but let's just say you spend $300 on all of these assets, but how much of sales are you actually generating, right, from the assets? And questions that we would answer there is, have we overspent in assets because it's not helping us to generate as much sales, right? We're not using the assets efficiently, or is it that we actually are doing really well, that the assets that we chose to invest in are helping us to generate sales? So it shows the dollars of sales produced by each dollar invested in assets. Okay, So let's go through here. It's asset turnover is the net sales, that number we already know, but here's another average, right? The average total assets. So we have to make sure that we remember how to calculate the average. I think we do. So let's go in. Again, this might become a little bit tedious because it's basically just applying a formula. You know, if I was super lazy, I could just say, oh guys, you know, chapter 18 is really easy. Go and study the formulas and you'll be fine. But the key part of this chapter is actually understanding what this formula is telling you. So we do have to spend some time calculating them, but then more time thinking about what does this mean. So net sales, it's come up a few times already. We know it's 100,000, but we don't have a number for average total assets, right? So again, it's going to be the beginning assets. Sorry, this was not the right span. Beginning assets plus the ending assets over 2. So if we go and look at what's happening with this company, you see total, this total over here is total assets. Okay, it doesn't say total assets, but if you remember our balance sheet works, the top part is the total assets, the bottom part is the total liabilities and stockholders equity. So the total assets at the end of 2016 was 120, 100. End of 2017 was 110, 500. So those are the numbers that we will be using to calculate our average total assets. So it's 120, 100 plus 110, 500. Again, for future reference, if you don't know where these numbers come from, and you divide by 2. So the average assets number is 115,300. And that number you plug back up here, right? So you're going to say 100,000 divided by 115,300. So you get this number, 0.87. So the question is, what does that mean? All right, and so the turnover is generally expressed in times, but the easiest way to understand this, right, is for every dollar invested in assets, the company generates 87 cents in sales. All right, so it's not got to do with, you know, the other times we had turnover and we said so many times it was like, oh, we sold this thing so many times per year, we collected this thing so many times per year. But yeah, you're really thinking about how well are you using the assets. So you're saying, well, I put $1 into an asset and I'm able to get out 87 cents in sales. Is this good or bad? And the answer, as usual, is that it depends on what the number was in the prior year. It depends on the industry, etc. We don't know. To me, the number looks, you know, a little bit low because you're saying you're investing, you know, $1 in assets, but you can only turn over 87 cents of that dollar into sales. I would have, if it was my business, I would have wanted to be a bit more efficient in terms of generating sales. But it could be that last year we were at 0.7 times, so we're actually getting better. We don't know until we see the previous year's numbers. Does anybody have questions on that? All right. Sorry if you hear any screaming in the background. My daughter's playing around, so apologies. So the next one sounds similar to asset turnover, but it is different because instead of dealing with net sales, we're dealing with net income. Okay, so return, the word return normally implies that you're looking at some type of percentage. You want to see what percent did you get back. Like if someone says a return on investment, they're generally saying for the, for what I put in, what percentage of that am I getting out? So return on assets is really also measuring profitability, but saying how much net income is generated by the company's assets. Again, all of this has got to do with trying to figure out if the assets that we've chosen to invest in are able to help to stimulate the profitability of the business. Because if they're not, then we probably have to get rid of some of them and reinvest, right? So those are the types of things. Maybe the assets are too old. Maybe it's not the right type of assets that we bought. Maybe some assets are being used, but others are idle. So we should actually sell them. These are the types of answers that we can get from formulas like this. So return on assets, net income divided by average total assets. All right, so net income for this question, based on reading the notes, we already know is 15,000, right? The average total assets we just calculated above, so you can take, it's the same number. It has to be the same number, right? Because we're dealing with the same company. So 15,000 divided by 115,300. And so where does that get us? Remember, this has to be expressed as a percentage. So this number needs to be converted to percent. And we'll keep 2 decimals. So 13.01% is the return on assets. And for the explanation here, we're saying the same thing, right? For every dollar invested in assets, but now instead of talking about sales, you're saying the company was able to generate 13 cents in net income. And the same thing, is this good, bad, ugly, indifferent? We don't know. We need to do some comparisons, but this question is not asking us to do more than 1 year. So we'll just leave it at that. That's return on assets. How well, right? The question is, how efficiently or how well are we using our assets? In this question, let me just see what else they ask for. Okay, they do have return on common stockholders' equity. So that's, they go up to return on common stockholders' equity, but they don't ask for these last 3, but the last 3 will come up in another example. So return, again, we're in profitability ratios. I'm sure you see now why it's good that you're not being asked to memorize all these formulas, because they sound similar. And it's a lot of stuff to remember. So return on common stockholders' equity is saying, right, how profitable is the company from the stockholders' perspective? In other words, for every dollar of equity that the common stockholders are putting into the company, how much net income is being generated, right? If you think about, if someone were to approach you to invest in a company, you want to know that that company is going to be profitable. Otherwise, what ends up happening is you invest in the company is not able to turn a profit, so they end up not really having much cash, and then the person is probably going to hit you up again to say, well, can you give some more money and more money? And then in the end, it becomes difficult to know when to stop investing, because, with a lot of people, it's always like the good times are just around the corner. So if you were approached to invest in something, these are the types of questions that you want to ask. And or if you were looking at investing in a stock or whatever, you're saying, you know, how profitable is this company really? If I put in $1 of equity, what type of net income does this company expect to produce? Now, granted, net income doesn't mean dividend. Like they could make a whole lot of net income and not pay you any dividends. But the point is still that that money is attributable, you know, to your investment. So the stockholders equity return formula, net income divided by average common stockholders equity. We have to remember that if there is preferred stock in this company, the entire net income doesn't belong to common stockholders. Whatever is allocated for preferred dividends has to be deducted first, because it's only going to be the residual, the leftover amount that actually belongs to the common stockholders, all right? So some of the questions won't have preferred dividends, but I will always write the formula out with the preferred dividend piece included, because I don't want you to forget about it in case there are questions where there's a preferred dividend. It needs to be deducted, because remember, the preferred stockholders have preference, so they will always get paid first before the common stockholders get paid. So here we go with return. Okay, so return on common stock holders, and you can see it's on common stockholders equity, right? We already know what the return is for preferred stockholders, because they get paid a percentage of par value as their dividends, right? Those things are contractually agreed upon. So we don't have to calculate a return for preferred stockholders, it's set. But for common stockholders, it's not set, because it's dependent on whatever they, you know, kind of whatever is left over after the preferred dividend is dealt with. And it's over average common stockholders equity. And so, of course, here we see again, there's an average that needs to be calculated. So in a second here, I will go and do that. So it's the 15,000 net income, and it's minus 0 because there's no preferred stock. And now we'll do average common stockholders equity. And it's again, right, beginning plus ending divided by 2. And make sure when you use your calculator that you are doing the math properly, because sometimes with, especially if you do things on the phone, sometimes if you do a number plus another number and just immediately divide by 2, sometimes the device only divides the second number by 2. So, you know, say 1 plus 2 equals, and you get the answer 3, and then divide by 2 for some of the phones and stuff that don't do the correct order of operations. All right, so we need to find common stockholders equity. Oh, sorry, I'm going in the wrong direction. That number is not given in the question as a total, so we have to remember what goes into stockholders equity. Liabilities would not be a part of that, but certainly the common stock and the retained earnings. So that means we have an additional calculation to make here to see what's the total for 2016 and then 2017, and then we will divide that number by 2. So we're going to say 2016, you've got common stockholders equity, there's 69,000 plus 20,000, so it's 89,000. I'll just put the formula here for just in case. 69,000 plus 20,000. And then for 2017, you've got 75,000 plus 23,130. So 98,130. So 75,000. All right, so those are the two numbers that still now have to be divided by 2. So this plus this is that, right? And give myself some more space here and divide by 2. And so it's 89K plus. So that's the number, 93,565. So this number goes back up here. Right, that's the average that we were looking for. All right, and so the answer here is 15,000 divided by this, which looks weird, but remember this has to be presented as a percentage because it's a return, so it's 16.03%. Okay, so
Do you need the 0.03? Can you just put 16%?
it depends on what Wiley tells you. Remember that red writing that they always have? They'll tell you exactly what to do. They may say round to the nearest percentage, which would be 16, or they'll say keep 2 decimal places on all of your calculations. It depends. All right. If we were doing this in class and it was me, I normally ask you to keep 2 decimals, just so I can be, make sure that everything checks out. All right, because sometimes people they round too much in the preceding calculations, and then it kind of truncates the whole thing. So read whatever Wiley says. That's your best bet. In fact, let me just I don't know if maybe I've already been kicked out, but I'm going to go in and just see, because it does sometimes. I've had people contact me for these homeworks sometimes and get frustrated, and then it turns out that the instructions were there. Yeah, see here, round answers to 1, so they want to keep 1, so then you keep 1. If it says round to 2, you keep 2. Okay. Then what does this mean? For every dollar that the common stockholders invested, they earned 16 cents. So again, good, bad, ugly, indifferent. It depends on what what other investments are returning. It could be that 16% is phenomenal, because if I had put my money in the bank, although it might be somewhat safer, I was going to get almost 0%, right? If I put my money in some type of bond or a debt instrument, I was going to get close to 0%, like a treasury bond or something. So if this company is able to return 16%, I am way outperforming other investment options that I had. I could also, however, look at the company in previous years. If they are not doing as well this year as previous years, then I go back a few years to see if there's a steady decline, right? If there's a trend downwards or something, then I should be getting concerned about the company, because it means their profitability is going down. But if it's a trend up, then I'm kind of still riding the wave. So that's the story, 16 cents. Any more questions on return on common stockholders' equity?
Yep, we're good for now. Thank you, Professor.
And thank you for asking about the rounding, because that can cause a lot of consternation when people are busy with the homework and don't know, how to round. Okay, so that was return on common stockholders' equity for this question. The last thing we have left over is debt to assets ratio, but debt to assets ratio is actually part of solvency. I will do the formula with you, but I just want to remind you, and this will probably be next time when we join each other, that we still have these three profitability ratios to calculate, and those will come up in example 1. So I will do them with you, but let's just try to finish this question. And the last part of the question has one debt to assets. Has one solvency formula, excuse me. So if we could just switch gears from profitability to solvency quickly. This is the last of the 3 categories for the analysis. Remember, the first one was liquidity. We did profitability, now solvency. It measures the ability of a company to survive over a long period of time. And this is, again, where this whole bankruptcy thing comes in, right? When companies declare bankruptcy because they realize that they will not, over time, have enough assets to be able to pay off all the long-term liabilities that they have coming due. Long-term creditors and stockholders are interested in a company's ability to pay interest as it comes due. That's the times interest earned ratio, which will also come up in example 1 that we'll do together next time. And they're also interested in the company's ability to repay the value of the face value of debt at maturity. So if I invested in your bond payable and it's due in 5 years' time, I'm not necessarily maybe interested about whether you can pay off your current liabilities within the next year. I'm more interested in the quality of your assets so that I can have some assurance that within 5 years' time, you'll have enough money to pay me back whatever you owe me. So the debt to total assets ratio measures the percentage of the total assets that the company has actually financed. So in other words, that came from money that was debt, right, and not straight cash. So if you think about this, you can also think about a home. Like if you buy an apartment, you know that mostly we talk about 20% down. And someone asked me if they can speak to me at the end of class. Absolutely, I'll be on until 1 o'clock. So debt to total assets, when you buy a house, you probably, or a flat apartment, you put 20% down. So 20% is financed by you, your cash, but the other 80% is coming from the bank. So your debt to assets ratio is going to be 80% because 80% of your property is still a mortgage. So it's belonging to the creditors, basically. Indicates the company's degree of leverage. So this degree of leverage means how much have you borrowed, right? And provides an indication of the company's ability to withstand losses. The more you've borrowed, the less likely you are to survive if you're making losses. So if you think about all these companies that are declaring bankruptcy now, they were already having problems before COVID and all the lockdowns. They were having problems competing with online retailers. They were making losses already. They were borrowing and borrowing to just try to stay afloat. But now that they've completely shut down, basically, it's come to a head and they realize that they are not able to keep up with their interest payments, let alone the debt payments. The higher the percentage of debt to total assets, the greater the risk that the company may be unable to meet its maturing, means the stuff is coming due, maturing obligations. So here's the formula. Debt to total assets ratio is the total debt meaning liabilities. So whatever liabilities you have divided by your total assets. So if we're just going to quickly, with the 3 minutes that we have left here for this company, right, we're going to do debt to total assets, doing that, assets ratio, right? So it's going to be the total debt divided by the total assets. And remember, we're doing this for 2017. So if we look at the company's balance sheet For 2017, I'm looking for debt. The only debt that they have is accounts payable. They don't have any bonds payable or any type of other long-term debt. So this is looking pretty good, right? Because you don't have much debt here. So it's going to be the 12,370 of accounts receivable divided by total assets for this company. We already know that this is the total assets number, 110,500. And you don't have to make any averages or anything because the formula doesn't call for that. So 110,500. That's your debt divided by your total assets. Excuse me. Okay, never mind. So where does that end up? This number divided by that. This is also going to be expressed as a percentage. So you're going to convert it to a percentage, so 11.19%, right? So what does that mean? Approximately 11% of our assets are financed using debt. Or you could say for every dollar invested in assets, we have 11 cents of that dollar was through debt. Okay, so this is a decent percentage. I mean, it's even lower than, you know, like I said, with a house or an apartment, if you buy it, you would have had to finance way more than that if you didn't have the amount in cash. So to say that only 11% of your assets are financed through debt, it means the rest of it, right? 89% is equity. So that's great. The stockholders would be really happy because they don't have to worry about how much money we have to pay off to creditors. All right, and that's the end of that. I don't know if anybody has any other questions, but if not, I will talk to you guys again on Tuesday. Remember, Tuesday is a Monday schedule, and we'll go over the homework for Chapter 17. We'll do example 1 here for Chapter 18, and then we'll just do some more stuff in Chapter 18 so that you can get some more practice. All right? So go and have a great day. And